Hello and welcome to Managerial Accounting Financial Statement Analysis Overview. My disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2020 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Presentations from time to time will use information from third parties, the third-party information. The third-party information is a property of those respective copyright holders, and the author does not make any claim to the third-party information. Okay, so when we're talking about financial statement analysis, one of the things that I like to kind of look at first is quantitative versus qualitative analysis. And so really, where is this coming? What are we doing now? So in financial accounting, our focus was on creating the financial statement. So we've done that already. Now what we want to do is we want to analyze those results so that we can see is like, okay, how can we make ourselves better for the future? Is there something that we can be learning from our past? Is there a way we can go through and predict future results? So what I like to, when I'm looking at analysis, I like to look at it as qualitative versus quantitative, because the numbers aren't going to be telling us everything. There's also going to be some other factors in place. So quantitative is generally focusing exclusively on the numbers. Qualitative is looking at more external factors. So here's a great example of qualitative versus quantitative. So a company has a decision to make in terms of how much to spend. Using the numbers exclusively, what would you choose? So I have two alternatives. I have alternative A, which is 11 million units at $11 per unit, or I have alternative B. Well, alternative B is made up of three different components. You have 180 incidents at $200,000 per incident, 180 minor incidents at $67,000 per minor incident, and then you have 2,100 replacements at $700 per replacement. So if I was asked just to go through and compute the cheaper alternative, alternative A would cost me $121 million, or this 11,000 units at $11 per unit. Alternative B, if I multiply these through the 180 incidents at 200,000 each, the 180 minor incidents, and then the 2,100 replacements, is a total of $49.53 million. So quantitatively, we would choose alternative B because that is actually better than alternative A because I'm spending less money. So, and when I look at this is just on the numbers alone. I'm letting the numbers drive my decision. But now let's look at what I really pulled this example from. So for fun, if you have a parent or a grandparent, ask them if they were living in the United States in the 1970s, ask them about the Ford Pinto, and you should get a fun story. But Ford Motor Company was, they had a problem. And their problem was when their car hit a certain speed, that there was a problem with the car exploding. So now we're going to be a video within a video. Just give me a moment here. So this is a video that shows what happens when a Pinto is rear-ended at around, this is the Ford Pinto. So this is a car that's being rear-ended at about, I think it was like they said about 35 miles an hour, and then there you see it. Okay, so what happened is that Ford Motor Company knowingly sold a car that if it was hit at a certain mile per hour on impact, then the car would explode. And so Ford had a dilemma, and they said to themselves, and what exactly should Ford be doing? So let's go back and take a look at these numbers. So this is the car. So Ford said to themselves, like, okay, we can repair the 11 million vehicles that this related to. at a cost of $11 per vehicle, we can spend 121 million. Or what we can say is we can say "Burn, Baby, Burn," which is a famous disco song from the 1970s. And what they said was, okay, we're going to look at highway statistics and how many people would die as a result of owning this car. And so what they did was they said, okay, well, if we allow this product to go out into the marketplace, we're predicting that 180 people will die, and we'll have to pay them out $200,000 per person per death. This is back in the early 70s, so this was obviously different monies. 180 serious burn injuries, we would have to pay $67,000 per serious burn injury, and then 2,100 burned out vehicles that would cost us around $700 per vehicle. So this is the way the Ford Motor Company thought. They just thought in terms of numbers, and this is the Pinto memo. It's cheaper to let them burn. And so this is the whole thing. It's that they chose to say, "Burn, baby, burn." And so I'll share this link up here. It's a great little article or analysis up there. So when the Ford Motor Company, what their huge failing was in this particular instance is they looked at the numbers exclusively. What the Ford Motor Company did not do was to take a step back from the situation and say, am I looking at this the right way? And the real pain here is not the one thing that they did not factor into their quantitative analysis, especially as alternative 2, is what would happen as a result of the brand damage. So what was the brand damage to the Ford Motor Company as a result of offering the Pinto? And so this is really one of the huge takeaways, which was just, we can't just look at the numbers themselves. We have to look at the surrounding parts of it. Is that, can we really put a dollar value on a human life? Is that something that we should be going through and doing? So what I want to encourage you to be doing in this class is not only just to be coming up with, okay, here's alternative 1, here's alternative 2, but to take a step back from the situation and say to yourself, is there something that I'm kind of missing here? Is there something else that I'm not picking up here? So when we're looking at qualitative analysis, what this is really kind of going through and referring to is that going beyond these numbers. What are the backgrounds? So if I'm dealing with a company, who are the officers and directors? Who are the investors who are involved with the company? What's the background of the other company investors? And what is the industry that this company is operating in? So just beyond the numbers, because something looks really, really good, it doesn't mean that we want to be, going through and believing it or doing business with somebody. One of the major mistakes I made in my business career is I was referred by a colleague to a firm, and he said, oh, these guys are great. They're going to do a great job for you. And had I spent $300 on a background check prior to wiring the company's money, what I would have realized very quickly is that the person that I was dealing with was a complete scumbag. And they were not a good person. They had bankruptcies. They were really terrible people. So what I want to encourage you to do is, before you get into business with people, is to really understand who you are dealing with. I've put up some links here. Before you use a stockbroker, you're going to look at FINRA. And I'll put these also in the bottom link of the video as well. But this is a way you can go see, if I'm trusting somebody with my money, who is the person that who do I go through? Do I trust that person? Over here is for attorneys in California. So anybody who's a licensee, like over here, this is going to be for the California Board of Accountancy. How do I search up somebody's CPA license? So if you want to find out if somebody's a CPA or an attorney, or find out what their background is, these are great websites to go through and do. So just don't, when you're in a business situation, the numbers are part of the answer, but that's not the full answer. You have to look beyond the numbers. So when we're going now in terms of looking at quantitative analysis, is to say, all right, we have like these we have these numbers. How do we go through and analyze it? And the thing I would be showing you over here, and I have a few separate videos on this, but right over here. So one of the things we're going to be doing is in this chapter, we're going to be looking at ratios. And I have separate videos that walk you through the various different ratios for liquidity. And so I'm going to give you those links at the end of this presentation. But you go through and we'll be going through and doing, ratio analysis. But before we do that ratio analysis, and there are ratios for everything. There are ratios for accounts receivable, how liquid is it? There's for inventory. But before we do any type of ratio analysis, what the first thing we want to go through and do is to create what we call common-sized financial statements. And what that means is we're going to be dividing all of anything that's on the balance sheet by the total assets. And then at the same time, we're going to be taking anything that is on the income statement and be dividing this by total sales. Now, the reason why we do this is because when I'm going to analyze financial statements, where do I want to concentrate my time? I want to be concentrating my time on the areas that are the most relevant or significant to the company. So for example, if I said to you, well, would you want to use an accounts receivable turnover ratio or an inventory turnover ratio to analyze Home Depot? I wouldn't want you just to say, okay, well, I'm going to choose, inventory, or I'm just going to choose receivables. The answer is when I'm analyzing a company, if I'm given a choice, say, Bennett, what is the best ratio to use for analyzing receivables or for inventories for Home Depot? Well, what I would say to myself is, well, what percent is merchandise inventory of my total assets? And right here, this is about 14.5, this is about 51. So the total inventory represents about 29%, approximately 29% of the total balance sheet for Home Depot. Now, compare that to receivables. Receivables is $2.1 billion. And of the total $51 billion in assets, this is it's probably right around 4%. So what's really important to remember is that before we start going through and doing analysis and using ratios and everything else, we need to get a sense of the company for what are like their largest assets, what is their operations. Because what I will be giving you is I will be giving you a lot of different ratios. So over here, you'll see over here activity ratios, inventory turnover, accounts receivable turnover. You'll see a lot of different things, and I'll be providing these videos to you. So AR turnover and inventory turnover. But before you go through and you just start saying, okay, I'm going to use inventory turnover, you need to be asking yourself first, does using inventory turnover to analyze the Home Depot, would that give me something meaningful? And the answer is probably yes, because of how large the inventory balance is relative to the other items that are here. So this is why before we go through and do a financial statement analysis, we don't want to be walking in blindly. We want to create common size financial statements so that we can understand how significant are certain balances to this company. The other why, and what is common size? We're just basically, everything's going to be in a percentage, and you'll see that on a later video. So, but we want to go through and do this just because we need to really understand is that when we're looking at the ratios, am I selecting the proper ratios to really go through and analyze this company? What a common size financial statement will also do is that if I have over here let's say I've got total assets of 51 billion, and we're going to say that merchandise inventories here for the Home Depot is about 14.5 billion, or roughly 29%. If I use common size financial statements and I say, okay, well, Home Depot has 29%, and I compare that to a Lowe's, and let's take a look at Lowe's just for a moment. So these are the financial statements here of Lowe's. And now let's take a look at their financial statements. So we're gonna go over here to the financial statements, and so here, Lowe's has total assets of about $39 billion. And their merchandise inventory is about 13.1 billion. So if I took 13.1 billion and I divided that by 39.4 billion, I would come up with about 33%. So right over here, by putting this as a percentage of total assets, I can say that because Home Depot and Lowe's are in a similar industry, that they're on a common size basis in terms of a percentage of total assets, their inventory amounts seem to be relatively in line. That can also tell me other things too, is that if I'm looking at similar industries, should they be having roughly the same amount of these various different balances, say for example, for inventory. Now, I believe that the other part of the example that I gave you in that one is talking about a company like Facebook. Let's take a look at Facebook real quick. If we notice here for Facebook, Facebook does not have inventory, and they really wouldn't. It would be a virtual inventory, or they might have inventory in the form of our Instagram or our Facebook accounts or our WhatsApp. But here, though, for Facebook, they don't have inventory. So because Facebook is not a retailer, that is not the kind of business that they're going through and operating in. So again, when we're doing financial statement analysis, one of the other important parts is obviously we will be doing common size financial statements, but when you're comparing companies, in order for the ratios to really work, we need to be comparing companies in similar industries. So as I look at over here for Home Depot and then over here for Lowe's, these are generally going to be comparable because they're in the same industry. For a company like Facebook, who are they closest to? And that answer might be something like Snap, but Snap is significantly smaller than Facebook. But in any event, it's worth, when we're doing financial statement analysis, you really need to be comparing, apples to apples, as the saying goes. So, but again, we're going to start with making common size financial statements, and this is going to be before we're going through and looking at the ratios. So another thing that we'll be seeing in the homework questions is something called a horizontal or a trend analysis. And really what this is it gives us a way to look at a company's key, components, say something like net income or sales, and we're trying to determine what is the year-over-year growth. So as we'll see from your homework, what we're doing here is basically a horizontal, or what we call a trend analysis, is we're taking the total amount of the net income. We create a base year. Okay, so your base year is going to be the 100% level, or that net income divided by that net income right here. When I compare future years, I'm going to be doing that at the base year. So let's take a look at year two. Year two, this is here is 250,000. So in terms of a percentage, what percentage growth is this over year one? Well, the year one, comparing this over here to the year one, it's grown by 25%, or that 50,000 difference. So, but let's look at year three. Now, some of you might be saying, it's like, well, wait a second. Year three was 230, that's less than year two, so should that be negative? And the answer is not necessarily. Because if we're doing a trend analysis and we're comparing year three to year one, it's actually going to be higher, right? Because if when I'm doing this horizontal or trend analysis, I'm doing this using against the base year, right? This is not a year over year. Rather, I'm going through and doing this at the base year. So I want to thank you for watching today. If you have any comments or questions, please send these to 1812cpa@gmail.com. I will also be providing you links for the other videos on how to do financial statement analysis, also how to go through and prepare common size financial statements, how to look up financials at sec.gov, so that you can get a better context for this chapter. Have a great one, and I'll see you on the next video.